So now we shall talk about the market players, that is the stock market players and the stock price volatility. You see, after having understood what is a share, what is the profit of a company, what is dividend, what is primary market and what is secondary market, I am sure two questions will come to your mind. Number one, why should the shares be traded continuously on the stock exchange? You see, if you are an owner of a business, then would you sell your business if somebody is offering a slightly higher price and then repurchase it when it is available at a low price and again sell it off when somebody is offering a little higher price? Would you do that with your business? I'm sure you will not. But then when you purchase the shares of a company, you are actually becoming a very small part owner in that company. So why would you do that with the shares? If you are not doing it with your business, then why would you do that with your small stake in that business? And number two, why should the share price fluctuate at all from moment to moment and day to day? See, the companies prepare their financial statements, their profit and loss statements, once in a year or maybe once in a quarter, tentatively. The valuation or the worth of the company does not change from minute to minute. Then why should the price of the share change from moment to moment? Now, both these questions are interlinked. But to understand this, we first need to understand as to what is the market price, or rather what is the spirit behind the market price of a share. And to understand the market price or the market value, we first need to understand what is the face value and the book value. Alright? So, understanding things from the basic, I have already explained actually what is the face value and what is the market value and all those things in one of my other courses, which is titled Understanding Financial Statements. But notwithstanding that, let me explain to you very briefly the same thing here again. Alright? So the face value, when we talk of the face value of a share, it is actually the initial price of the equity share representing the equity capital of the owners or the shareholders. Alright, we remember when we talked about that Pipe and Garments Limited, initially the promoters pooled in 10 million and divided it into 1 million shares, each constituting a face value of $10, isn't it? So the face value actually is the equity capital divided by the number of equity shares. And we know when we talked about that FFGL, there were $10 million pooled in by the promoters. Each of the 5 promoters pooled in a different amount. And then they converted into 1 million shares. And therefore, the value or the face value of each share was $10. And they divided it among themselves proportionately, isn't it? So that is what the face value of the share is. And the term face value was coined, because this value used to be printed on the face of the share certificate. In earlier days, when the share certificate was in the physical form, was in the form of a paper, then on the face of that paper, this value of the share was printed. Alright. Now coming to the book value. You see, as the company keeps earning profit, we have discussed that some small portion of that profit the company may distribute as dividend, but a major portion of that profit the company may reinvest in the business as reserves and surplus. Alright. So the value of the shareholders' money will keep increasing in the books of accounts. Books of accounts means the financial documents, the balance sheet and profit and loss statement and all those things. Okay. So though the initial price of the share, that face value will remain the same, on the paper the face value will remain the same, but in the books of accounts the value of that investment will keep on increasing, and therefore the book value is actually the equity capital, which is this equity capital, plus the reserves and surplus divided by the number of equity shares. So as the reserves and surplus, or the profit generated by the company and reinvested into the business, keeps on increasing, the book value of that share, or the value of the share in the books of accounts, will keep on increasing. So we saw that just before the IPO of FFGL, the equity capital was 10 million, and then they had earned a reserves and surplus, the retained earning from the profit, of 15 million. But the shares were the same, 1 million only, isn't it? The shares had not increased before the IPO. The shares increased after the IPO. So before the IPO, 10 plus 15, 25 divided by 1 million, that gave us a book value of $25 per share. So though the face value of the shares of the promoters remained $10 per share, their value in the books increased to 25 per share. Alright, let us try and understand it in little more clarity by understanding the growth trajectory of this Five Friend Garments Limited. Alright, we have discussed that face value is the equity capital divided by the number of equity shares, and the book value is the equity capital plus the reserves and surplus divided by the number of shares. So as the reserves and surplus keep on increasing, the book value will keep on increasing. So now equity, reserves and surplus, face value and book value. Let us see how they change. Okay. So in the first year of existence of that company, we are talking about Five Friend Garments Limited. Okay. In the first year of existence, we know there were 1 million shares taken by the promoters only. There were no public in that company. And the equity capital was 10 million. The reserves and surplus was nil because the company had just started. So the face value was 10 million divided by 1 million. That was $10 per share. And since there was no reserves and surplus, the book value was also 10. Got the point? There were no reserves and surplus. This was 0. So therefore, the book value was also $10 per share. Now, just before the IPO, in the 5 years between their commencement of business and coming out with the IPO, the company had earned a lot of profit and reinvested a large portion of that profit back into the business. Alright. So though the equity capital remained the same, the reserves and surplus had increased to 15 million. From nil, the reserves and surplus had become 15 million. So therefore the face value remained 10. This 10 million divided by 1 million. Okay. So face value remained 10. But because the reserves and surplus had propped up, the book value became $25 per share. So the value of the investment in the books of accounts increased from 10 to $25 per share. And then just after the IPO, what happened in the IPO? The company gave away 0.8 million shares to the public. Okay. So the number of shares increased from 1 million to 1.8 million. And the face value of each share was $10. Plus they had some premium. That premium went into the reserves and surplus. Isn't it? We have already discussed that. So the equity capital became 18 million. 10 million was already there. By giving away 0.8 million shares at face value of 10, another 8 million came into the equity capital. So equity capital became 18 million. And the reserves and surplus became 69.4 million. We have seen that already. Whatever the premium in the offer price the company had taken from the new shareholders, the public shareholders, all that premium amount went into the reserves and surplus. The $10 face value went into the equity capital. Okay. So now the face value became 18 million, this equity capital 18 million divided by 1.8 million shares. The number of shares has also increased. Okay, the equity capital has increased, the number of shares has also increased. So 18 million divided by 1.8 million, the face value of the shares still remain $10 per share. Isn't it? You got the point? But what happened to the book value? The book value became 69.4. This equity capital plus reserves and surplus, that means 18 million plus 69.4 million divided by the number of equity shares, that is 1.8 million. Alright. So this became 87.4 divided by 1.8, $48.55 per share. See how the book value is increasing? The value of the investment in the books of accounts, that is increasing. That means the worth of the company is increasing. Alright, that is growth. And then we saw that the company also came out with an FPO. Okay, and just before the FPO, before the company came out with the FPO, there were still 1.8 million shares. During the FPO, the company would offer more shares and then the shares will increase after the FPO. But just before the FPO, it was 1.8 million shares only. And the equity capital was the same, 18 million. Alright. But we had seen that during the 5 years between the IPO and the FPO, the company earned huge profit and a large portion of that was reinvested as reserves and surplus. So the reserves and surplus increased to 150 million. Isn't it? Just recollect, we have already seen that in the previous lessons. Okay, so now the face value still remains $10 per share because this 18 million divided by 1.8 million, it remains as $10 per share only, the face value. But what happens to the book value? The book value became $93.33 per share. You see, this 150 plus 18, that is 168 equity capital plus reserves and surplus divided by 1.8 million. So that becomes $93.33 per share. See how the company has grown. The book value has kept on increasing. The face value remains the same. The face value will not change unless the company splits the shares. What is splitting of the shares? That we will see subsequently during the course. Alright. So the face value remains the same, but the book value keeps changing. We have seen that as the reserves and surplus keep building, the book value keeps increasing. So the book value actually indicates how much is the worth of the owner's money in the books of the company or in the books of accounts. That is the equity capital plus the reserves and surplus. Alright. So now just think over. Should the share price not be the same as the book value? Should the shares not be bought and sold at a price which is somewhere around the book value, maybe a little more? Because the book value is actually telling you what is the worth of the company in the books of accounts, isn't it? So when you are selling the shares of that company, should it not be somewhere close to the book value, maybe little more considering the profit of the seller? But you will seldom find that. Most of the time, you will find that the market price of the share is either much lower than the book value or very much higher than the book value. Very seldom you will find that the share price or the market price of the share is close to the book value. Alright. Why is that? The answer to this question we will see in the next lesson. So it is a continuous learning process. In this lesson we have seen what is the face value, what is the book value, why does the face value remain constant, why does the book value change, and what is the market price. Now, why does the market price change? Why does it fluctuate? Why is it not close to the book value? Answers to these questions we will see later. All right.